Corporate acquisitions, buy versus build. In previous videos, we've talked about the main thesis for most private equity acquisitions, and this being aggregation, consolidation, roll-up strategies that lead to multiples expansion. Now, corporate acquirers, or larger organizations that are buying things not necessarily to own them for 5 to 7 years and then sell them again, but more to integrate them into a larger operating company, are oftentimes buying for a different thesis. Now, they still want things to be fundamentally sound and most often profit generating, but by the same time, they're looking at, as we've mentioned in prior videos, access to certain end markets, certain aptitudes or capabilities, certain innovations, intellectual property. There's a lot of reasons why there are corporate acquirers, but fundamentally, all of those ideas boil down to this concept of buy versus build. So let's say you're a gigantic telecom company, at Verizon and AT&T, and you want to get into a certain area of device-to-device communication, right? Sort of that Internet of Things, but say it's security cameras that talk to each other through technology that automate access control somewhere else in an ecosystem of connected devices. And that's an example of something that they would probably like to be in, but are not in. Now, if you're AT&T or Verizon and you're at that executive level and you're contemplating, how do we get into this space? How do we become a player in this space? And how do we get ahead? And how do we get an advantage in it? The analysis will always boil down to buy versus build. And so if you're a large company, you have access to lower cost capital, whether that be equity or debt, and you have an ability to go out and quickly acquire things, then oftentimes it's going to be advantageous to just buy something versus build it yourself. Right? It's like Prometheus starting fire. The first few inches, the first few dollars of any particular business are the hardest ones, and thereafter every incremental dollar takes that much less pain and time and resources. And therefore, if you can acquire a business, even just kind of in its embryonic stage, but a little off the ground, so you could be a multi-billion-dollar company, and if you can acquire a business that makes $1 to $3 million of profit a year, the amount of resources, time, and energy saved in just acquiring that company, even if paying a meaningful premium over what a private equity firm would pay for it, is far more advantageous than trying to build that itself, right? You can think of these large organizations, it's like turning a large oil tanker versus a speedboat, and therefore if they can acquire the more innovative, nimbler situation, and oftentimes even get some of the people to join in with them, that can be a really intelligent path for them. And so whenever someone asks us, why does private equity do what it does? Why is private equity interested in these particular industries? And we start talking about the multiples expansion, the aggregation strategies that we see, we're oftentimes asked, why are corporations buying these things? And the interesting thing in that particular conversation is that they don't always ask, why are they buying it? Because logically, it would make sense that if you had a wonderful new beverage, that Pepsi would be interested in it, or if you had a wonderful new technology, that IBM or Microsoft may be interested in it. But the question that we get is kind of that secondary concept of, why don't they just do this themselves? And the answer oftentimes is, it's a lot cheaper, even if they're paying twice as much as what a private equity firm would buy a particular company for. It's far cheaper to do that than to have to assemble all of the people, assemble the strategy, and build it themselves. And more inexpensive does not mean necessarily purely dollars, but also time, which leads into the attainment or missing of gaining the competitive advantage in a particular industry or particular vertical. And so from our job of representing companies as we're seeking to exit the businesses, we always want to think of the company from the perspective of, what puzzle piece does this fit the perfect slot into for a large organization? And so when we're talking to prospective acquirers or capital providers for a situation, we're looking at the full spectrum. So it's going to be financial buyers, middle market private equity, lower middle market private equity, family offices, search funds, independent sponsors, the whole spectrum. But then looking at the corporate acquirers as well, we are looking at them not just from the angle of who has the available capital and how would they value this, but looking at their entire landscape and their entire puzzle, if you will. Where is this the missing link? Where is this the missing piece? Because if you can paint the picture or characterize a situation, not necessarily from the perspective of how much is this worth objectively, but how much is this worth to you? How much is this worth to a particular company? What kind of pain will this avoid for a company? What kind of advantage will this give the company? Well, then valuation takes on a whole different meaning and can certainly take a different angle in the conversation. And so that's a thought for today. We've discussed previously how private equity looks at deals and what are some of the strategies and kind of underpinning theses for those strategies. And now from a corporate perspective, the idea of buy versus build. Whenever we're contemplating why a company would buy something, we not only say, does this fit, but what pain does it avoid, what advantage does it provide, and why is it that much more important to buy this or to acquire this versus building it from scratch. So that's a thought for today. Hope the week continues to go well for everyone. Keep pushing forward. God bless. See everyone next time.